After a relatively stagnant Monday, the US dollar kicked off Tuesday with losses. The greenback began losing value shortly after the opening of the Asian trading session. Its weakness is most likely due to the upcoming speeches by several Fed officials today. Regulators from other leading economies are not silent either. Macroeconomic data is adding to market jitters. Thus, an intriguing picture is emerging regarding the US dollar and major FX currency pairs. The main concern for central banks is inflation. While the United States and the eurozone are expecting its easing to cut the interest rates, the situation in Japan is much more complicated. The Bank of Japan has to maintain a balance between an alarmingly weak yen, still ultra-low domestic interest rates, and a broad-based wage increase, which logically should drive up prices. Recent data showed that consumer price inflation in the country slowed to 2.5% from 2.7%. However, this figure is still above the Bank of Japan's target rate of 2%. A sustained increase in consumer prices is prompting policymakers to consider raising interest rates, with experts speculating on one or two hawkish decisions, including a rate hike of up to 0.5%. Such a decision will undoubtedly support the yen. In the meantime, the Japanese currency is only being backed up by verbal intervention from financial authorities. Today, Finance Minister Shinichi Suzuki emphasized the importance of currency stability and expressed the need to closely monitor the situation in the forex market. His speech prevented the Japanese currency from falling. As a result, the pair spent the first half of the day trading in the range of 156.60 to 156.90 yen. The yen was also supported by a weak dollar ahead of global inflation reports, and amid a slight pickup in the risk appetite, the greenback edged a bit lower. As a result, the US currency has been trading downwards for the third consecutive day, with the index measuring its value against a basket of 6 foreign currencies, consolidating in a tight range of 104.40 to 104.50. After a long holiday weekend, Wall Street is likely to edge higher, beyond by improved risk appetite. Moreover, strong earnings reports from American corporations and their favor around artificial intelligence continue to fuel the US stock market rally. Today, the S&P 500 is expected to trade upwards within a daily range of 5,278 to 5,312 points. Stock market sentiment typically aligns with the movement of the single European currency. After all, the euro and the Wall Street are inversely correlated with the US dollar, and today the major pair has risen to 1.0877 and is likely to extend gains according to the daily time frame. The correction around the support level of 1.08 seems to be over. The volume of short positions has decreased, signaling a gradual recovery process for the euro. Now the price needs to break through and stay firm above the resistance level of 1.09. In this case, our analysts do not rule out a continued rise in the euro to the 1.10 mark. Alternatively, the price could get stuck in a sideways range between the critical levels of 1.08 and 1.09. Notably, several Federal Reserve policymakers are scheduled to speak today. Given their previous comments, the market expects them to step up their hawkish rhetoric. While a rate cut is anticipated, it's not imminent. Markets anticipate that the Fed will pivot to monetary policy easing in the autumn or perhaps even next year. Meanwhile, the vast majority of European central bank policymakers are on a track for a rate cut as early as next week. Against this background, the dollar is expected to resume its bullish run against the euro. Supported by a weaker dollar, oil prices returned to the previous range, bounded by the support level of $82 and the resistance level of $84 per barrel. According to our analysts, the most likely scenario is a gradual rise towards the upper boundary of this range. After that, Brent crude is likely to reverse and pull back to the support level. All in all, the market situation has remained unchanged for months now. Today, the benchmark is actively recovering lost ground. Oil spent the first half of the Tuesday trading above the $83 per barrel mark. Over 2 trading days, the asset gained 3% after testing the psychological level of $80 per barrel. If the uptrend remains intact, Brent crude is expected to head for the $84 mark. You have watched Market Review on the InstaTraders channel. We wish you profitable trading and see you tomorrow.